Back when I was at university, I had a friend who was really into horse racing. We used to call him Grandad Josh because it was sort of like he was this 21-year-old going on 65 years old. Now, some days when I was procrastinating from my uni work or skipping a lecture here and there, I'd actually join him and go down to the bookies. And he'd stand there along with all the other granddads, 3 or 4 times his age, just watching the TVs and betting on the various horse races that were going on that day. And I'd see Grandad Josh watch the TV, then jot something down in his notepad, do a few calculations, then he'd write out his betting slip, take it to the cashier and place his bet. Now, most of the time, he was betting on an outside bet, a complete underdog, and only very occasionally would he actually bet on the favourite. And it was never just based on the funniest sounding horse name like my bets were.
In the middle of the track is Arg! Coming down to the final 16th, it is Stand Pat in front. Arg! Arg! Arg in front, coming down to the wire. They're coming to the finish, and it's all Arg! Feline fell in second, Stand Pat third.
So I'd ask him what his process was. You know, if the favourites were most likely to win, why wasn't he just betting on the favourites? And that's when he told me something that was shockingly obvious and surprisingly simple, and it's stuck in my head to this day. It's actually impacted the way that I approach my trading. You see, he wasn't looking for which horse was most likely to win. He wasn't even betting on which horse he thought was going to win. I know it sounds a little bit counterintuitive. But what he was doing instead was looking for the horse that presented the best value. In other words, if that same race was run 100 times over, which horse would generate the best return for him? It might be that a horse has odds of 100 to 1, but if Grandad Josh thought that that horse might win even just 5 times out of 100 races, it's likely to be a much more profitable bet than backing the favourite, even if the favourite is more likely to win than that outside horse. So he wasn't focused on that individual race. It didn't matter to him the results of that race. He was focused on his own performance over time. So it's the accumulation of all the races that mattered to him. So what does this have to do with our trading? Well, think about when you perform your technical analysis. What is it that you're trying to do? For most traders, they're going to be trying to predict what's going to happen next. In fact, many traders post their analysis online with all of these arrows showing where they think the price is going to move to next. So this means they're looking at different potential outcomes for the price and choosing the one that they think is most likely to happen. In other words, they're backing what they think is the favourite each time, the one that's most likely to happen. But instead, if they want to maximize their success over the long term throughout their trading career, they should be approaching things a little bit differently. So rather than trading the most likely outcome, they should be trading the one that has the highest positive expectancy. The one where if you encountered a similar situation 100 times over, would be the one generating the most profit for them. So for my trading, I use something that I call a context-based approach. I spoke about it in loads of detail in a video right at the start of the year, which you'll find linked up here if you want to watch it. It's definitely worth watching if you want to start using a more profitable approach to trading. So what I'm basically doing is assessing all the different outcomes that could happen from where the price is right now. Where might the price move next? And what would those different price movements mean for the context of the market? Now, for each of these potential outcomes, I'm considering what I refer to as the quality of the trade. Now, I like to keep this quite simple and just look at 3 broad aspects of the trade. I have the risk, the reward, and the estimated probability. Now, these 3 combined will show me the overall quality of the trade. So if we think back to the example of horse racing, we had the risk and reward, which were the odds on that horse. For example, if a horse had odds of 30 to 1, the risk is 1, the one that you bet. So if it loses, you'll lose that 1, and the reward is 30 if the horse wins. Now, the missing piece there is what you consider the probability of that horse winning to be, which makes the overall situation therefore profitable or not. Does it have a positive expectancy or not? In some cases, the probability of it winning might be very, very low, meaning it's much more likely that if you put a bet on or if you open a trade, then it's more likely to be a loss than a profit. But the risk and return involved in that situation might still make it a high quality trade overall. For example, if the chance of success is just 20%, but the risk is 1 and the reward is 10, it means if I open that trade, I'm much more likely to take a loss than to make a profit. But if I open that same trade again and again over time, I'll make a profit overall because it has a positive expectancy. So this understanding means that when I assess a situation, I don't just look for the most probable outcome and think about whether that most probable outcome has a risk reward that makes it a viable trade for me. I also look at the other potential outcomes and think about whether the risk reward of those make them viable trades as well, and maybe even better trades than the most probable outcome. So not only does this lead to me opening better trades, but it also increases the number of possible trades I can open because there are fewer restrictions. I don't have to always trade the situation I think is most likely to happen. Now, this sometimes leads to you taking trades that go entirely against the grain, where you know that you're likely to lose that trade. But it's by focusing on the long-term accumulation of your results, so your long-term performance, rather than each individual trade, that you become a great trader. In fact, sometimes the most probable outcomes in a situation have a long-term negative expectancy, and I think that that's often what destroys many traders without them ever realizing why. So the best techers for great trading is to not always back the favorite, but to consider all potential outcomes and look for the ones with positive expectancy. And if you do that, you'll be making Grandad Josh very, very proud. So look, there are two things you desperately need if you want to make this work for you. The first is that you need a consistent system. Otherwise, you won't see the long-term benefits of this approach. You'll just end up keeping on taking short-term losses. And the second thing is that you're going to need a context-based approach. So to understand that, I'd recommend you checking out our video on trading a context-based approach. It will appear on screen at the end of this video. And there's also a link to our free training if you want to learn more about the way that I trade the markets and the way that I look at things. Please do hit that thumbs up button to support the channel, and maybe even leave a comment below letting me know whether this is something that you're already using with your trading or whether it's something that you'll consider using more in future. Just in case Grandad Josh comes along and sees this video, I'd like him to see some feedback there. And I'll see you in the next video. Thanks a lot for watching. Take care.